So what do you do when you've got two almost identical stocks? How do you figure out which one is a better investment? In today's video, guys, we're going to take a look at Lowe's versus Home Depot, and I'm going to give you my process, exactly what I look for when comparing two stocks head to head and figuring out which one I want to put my money into. Hopefully, this can help you build your process and become a better investor overall. We're going to look at three key metrics or three key categories: value, growth, and technicals. So let's jump right in. What's up, guys? Welcome back to This Just In. Thank you so much for joining me today. My name is Justin and I am your host. In today's video, we're going to take a look at Home Depot versus Lowe's. Guys, I have a lot of people ask me all the time what my process is when I'm trying to find two very similar companies and which one is the better investment. Lowe's and Home Depot are extremely popular home improvement companies. I don't think anybody doesn't know who Home Depot and Lowe's are, guys. They're the biggest home improvement companies on the planet. When you've got two companies that are almost identical, how do you figure out which one is a better investment? In today's video, I'm going to give you my process and all of the key metrics that I look at in the value area, growth area, and also the technical area, so that I can make the best possible decision of where I should put my money. And hopefully it can help you build a better investing process for yourself. I know a lot of people say that you shouldn't mix fundamentals and technicals. I strongly disagree. I think it is the best way that you can not only find the company that you think is the better value and has the best growth potential, but then you can also make the most educated decision of when you should put your money in, where you should take profit, stop loss levels, and things like that. Real quick, guys, before we get started, subscribe to the channel if you're new around here and want to see more videos like this. Come over and join us at the Patreon if you want to get all of our trade setups. Day One Squad, I love you so much. Thank you for your support. Let's get started, guys. First thing we're going to look at. So this is a spreadsheet that I put together that's just kind of a visual representation of the key metrics that I look at in each category. So we've got up here at the top, guys, right here. This is just kind of some the details about the company, right? I just kind of threw that up there so you can kind of see the difference when it comes to like the big stuff. Market cap, trailing 12 months revenue, things like that. Real quick, guys. Home Depot and Lowe's, they're almost identical. When it comes to a shopping experience, you have some people that are diehard Lowe's fans. You've got some people that are diehard Home Depot fans. For me, I don't really care. They're the same store to me. I'm not a huge home improvement guy. When I go in either of them, they both have what I need. So I think that's personal preference. When it comes to actual like fundamentals, when it comes to an actual stock, Home Depot is obviously the much bigger company. I would say, much stronger brand in the sense of, worldwide, global, right? They are almost double when it comes to a lot of the metrics here. You can see market cap about 300 billion versus Lowe's at 120 billion. So, just under double when it comes to, or just over double when it comes to size. Revenue in the trailing 12 months, about $60 billion less when it comes to Lowe's. Same thing with net income, guys. 8 billion versus 16 billion. So what I'm getting at here is Home Depot is a bigger company, almost by double exactly in a lot of areas. However, I think that Lowe's is going to provide a better growth opportunity. Home Depot is going to provide a better, more consistent opportunity, but we'll just have to take a look at which one is a better buy at the moment. So as you can see here, guys, I've got it broken down into three main categories. We've got growth, value, and technicals. Now, these are the main metrics that I look at in each one of those categories. When it comes to growth, guys, I want to see consistency. So what I take a look at is I take a look at the 5-year revenue growth for each company. As you can see here, Home Depot has grown an average of 10% year over year when it comes to revenue growth. So for both companies, I took their year over year revenue growth for the last 5 years, added them up, and averaged them out. Lowe's, 8.45%, so Home Depot obviously won there. Now, I will say this, guys. This is a very top-down look, right? It's not like a super in-depth look. In my opinion, your analysis should not be hours and hours and hours. You should have a quick analysis that you can go through rather quickly and find the company that you like better, that you want to look a little bit further into. So that's what we're doing here. Now, real quick, Home Depot has been much more consistent when it comes to revenue growth. Lowe's was a little bit more up and down, and I think that's what brought them down to that 8.45%. I do think Lowe's has a better growth opportunity moving forward, but there was some chop over the last 5 years. The next thing, guys, is net income growth over the last 5 years. You can see Lowe's has grown their net income on average over the last 5 years, 28.9%. Very impressive, guys. I want to see companies growing revenue, but I got to see them making money. I can't just see revenue growth. Home Depot, 16.11%. Obviously still very strong, but Lowe's did take the cake there. The next thing, guys, and I would say the more important metric than net income for me, is free cash flow growth over the last 5 years. So again, I took their year-over-year growth for the last 5 years on their free cash flow and then averaged it out. Home Depot was insanely consistent, was growing it every single year, where Lowe's was up, down, up, down. They had a huge year and then a low year, huge year, low year. But when it comes to just the average over 5 years, Lowe's still takes the cake at 38% free cash flow growth, where Home Depot is at 13.38%. The next thing we're going to look at, guys, is the value section. Now, keep in mind, when it comes to growth, based off of those metrics, Lowe's did win there when it comes to overall out of those three key metrics. Now, value, we've got the PE ratio in the trailing 12 months. You can see Lowe's is currently sitting at 14.97, right there at that 15 that we want to see, where Home Depot is about 18.22, little bit high, but nonetheless not too bad. Lowe's did win though. When it comes to price to free cash flow, I did this a little bit differently. I used their price to free cash flow for the trailing 12 months, like with their outstanding shares, their share price, everything. But I used a 5-year average for their free cash flow number just to create a little bit more consistency. So I took their 5-year free cash flow numbers, I averaged them out, and then I put that in there when I was doing the ratio of price to free cash flow. You can see Lowe's is currently sitting at 20.55, Home Depot 23.8. So Lowe's has got a better price to free cash flow ratio, guys. That's pretty insane. I would have thought Home Depot was better, but looks like Home Depot's just a little bit overpriced still at this current time. Now, the shares outstanding over the last 5 years. Home Depot is doing much better at buying back more shares. Home Depot has bought back 25.2% of their shares over the last 5 years, where Lowe's has bought back almost 15%. So 10% difference. That's very impressive. Exactly what we want to see. Now, Home Depot does have a little under double the shares that Lowe's does, but nonetheless, I like to see Home Depot buying back their shares. But, still Lowe's buying back 14.8% is still very impressive. Now, next thing, guys, is technicals. We want to jump over to the chart and we'll look at that. I just do under the 200-day moving average or over. You can see they are both currently under their 200-day moving average. That is not what we want to see. We want to see it over it. 1 year performance, Lowe's stock has performed. It's up 2% over the last year. Home Depot's is down 4%. Long-term uptrend, they are both in a long-term uptrend. But let's jump over to the discounted free cash flow sheet so we can get an idea of which one is a better intrinsic value. So as of right now, guys, if we jump back to that sheet, I'm currently leaning much more towards Lowe's when it comes to an investment, because to me, it looks like not only does Lowe's have a better growth opportunity, it also is currently at a better valuation metric. Now, like I said, discounted free cash flow sheet. The reason why I pull this up, guys, is so we can see what we should be paying for the stock at these current levels. You can see Home Depot, I just did 3% revenue growth for the next 5 years, 3% every year after that, 6% cash flow margin, which is about 1% less than what they're currently doing. They're doing about 7.5%, and I'm coming up with about $123 per share. I do think that we could up that cash flow margin a little bit, but based off of conservative numbers, the stock needs to fall more than in half, about 60% to get to that fair value price based off of these numbers. If we jump it up to 7% on the free cash flow margin, guys, you can see it brings the overall stock price to about $144, but nonetheless, it's currently at $300, so it is looking a little overvalued from the current levels. If we jump over to the Lowe's discounted free cash flow sheet, This one looks a lot better to me, guys. I did 3% revenue growth for the next 5 years and then 3% after that every year, just like I did on Home Depot. Now, I did have it set at 7% on the free cash flow margin. That's about what they're doing today. But I do feel that Lowe's is going to grow faster than 3% for the next 5 years. So I did give them 1% up on the free cash flow margin, but I will show you the same way I did with Home Depot. You can currently see the stock price is at $196 right now. The share price intrinsic value that I'm coming up with based off the sheet is $145, which is, 26% downside, to get to what this sheet says is the proper value. If we drop the cash flow margin down to 6%, we're coming up with $124. If you drop it to 5%, you're coming up with $103. So even at a 5% free cash flow margin with 3% revenue growth in perpetuity, you're coming up with less than 20%, 40% downside to get to fair value, where Home Depot, you're up there at around 60%. So I do think that not only does Lowe's look better when it comes to valuation, intrinsic value, and growth rate. Now let's jump over to the chart and see what we think about both of those. All right, so the first chart we're going to start with is the Home Depot chart. Now, I'm not going to spend a lot of time on it because I like Lowe's better when it comes to all of the metrics we've currently analyzed. So I'm just going to kind of show you some of the similarities, some of the differences. Then we're going to jump over to the Lowe's chart. Guys, they're almost the same chart, like they really are. A couple of things I will point out. Home Depot has underperformed Lowe's over the last year. Home Depot's down about 4.4%. Lowe's is up over 2%. But when you look at like the March 3rd, 2021 low versus Lowe's March 3rd, 2021 low, it is pretty interesting. This is back where we had the COVID crash. We broke the COVID crash. We rallied up to make an initial all-time high back in August 2020. We created a major inflection zone, and then we came back to test the top of the COVID crash. Now, Lowe's on the March 3rd low did not come all the way back to test the COVID high. So I just wanted to throw that out there. They're both under the 200-day moving average, but they're both over the 200-week moving average. Now, if you're currently in Home Depot, I will say this, guys. If you do not hold that 292.12, which is that initial high from August, you're likely headed to 247, 238, which again is that COVID peak. So keep that in mind. You did break it. You did jump back over it, which is, nice to see, but you absolutely could just be, attempting a rally to make a lower high than the previous high and dump again. So keep that in mind. You did have clear as day bullish divergence. Your relative strength index is making higher lows. You're out of the bearish control zone. You're, building positive momentum. So who knows here, guys? You could absolutely continue to run, go back up, test that 200-day moving average and dump again. Or you could trade sideways here and you could create that left shoulder head, come up, test this, pull back, make a higher low, and then run again. You got to get a higher low and a higher high, guys. You got to get back above 341 to 345, which is that high from May 10th. If you don't get back above that, the only place you're headed is back to the COVID top. That's what's going to happen, in my opinion, but you can let me know what you think down in the comments. Now, the Lowe's chart, guys, same type of stuff. Again, I like the Lowe's chart better because, again, this right here is that March 3rd, 2021 high or low after you broke the COVID top. So you have the dump, you rallied, you made an initial all-time high on October 2020, then you pulled all the way back and you were much, much higher above that COVID high. So you were outperforming Home Depot, ever since you got out of that COVID crash. And then you continued to rally, just insane strength here, guys. You can see under that 200-day moving average, but over that 200-week moving average. And you are at a really, really critical inflection point here, guys. Now, unlike Home Depot, you did not break that August and October, 2020 high. You stayed above it. Now, as long as you can hold 180, 177, I think you're in good shape. You just got to rally and get back above 208 to 211, which is that, again, that initial high from May. You break that, you're headed to 238, 261 after that. But if you do not hold, which again, you are starting to roll over here, guys, You are, same thing, making insane amounts of bullish divergence on your relative strength and your MACD on the daily, but you could just be reacting here because you're at a major support level just to run up and make a lower high than the previous highs and dump again. You break 180, 177, I'll see you at 148 bucks. You break that, I'll see you at 123 bucks. When it comes to the weekly, guys, if you take a look at where the 200-day moving average is, or 200-week moving averages, excuse me, it's right there at that 148. So if it's going to roll over here, that's probably where you're headed. Just keep that in mind. But I do like the fact that we've got some really nice stuff going on here with this piercing pattern on the weekly. You're losing your negative momentum when it comes to your MACD, and you are rejecting that bearish control zone as of today. So keep that in mind. When it comes to the retracement from the low, the COVID low to the high, you're sitting at about a 382 on Lowe's, and on Home Depot, you are currently sitting at you're actually at a 50% retracement on Home Depot. So Lowe's is clearly outperforming Home Depot when it comes to retracement from the COVID crash to the all-time high. Now, this is your golden retrace here, right, guys? You're the 382, the 50% retracement, the 618. I do like how that 618 is right there at that COVID top on Home Depot. Very impressive. Where your 618 on Lowe's is slightly above that COVID top. I do like how the 382 is, right there at that October high. So we'll just kind of have to see what happens, guys. I honestly like Lowe's a little bit better at these levels. I think the value is a little bit better, but again, that's just personal preference. I think Lowe's has some better opportunity over the course of the next 5 years, but I also think Home Depot is probably a more consistent stock and probably a little bit safer investment. I just think Home Depot needs to fall a little bit further when it comes to valuation metrics. So let me know what you think down in the comments, guys. This video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. Come over and join us at the Patreon if you want to get all of our trade setups, and I'll see you guys in the next one. Peace.